Every day, there are new twists and turns in this current banking panic. In fact, we recently discovered that the major banks had banded together to preserve the First Republic. It is fantastic news since the failure of First Republic would have been a massive disaster. But First Republic is only one of several banks that are in significant trouble. For months, business and economic professionals have repeatedly warned that increased interest rates will strain our financial system. It was unavoidable that financial institutions would begin to fail, and this is exactly what has occurred. We are significantly more in peril than most people think, and we are only in the early stages of this catastrophe. There were speculations that the buyer was looking for First Republic, but instead the two beg-to-fail banks decided to put a total of $30 billion into the travel institution. Bank of America, Wells Fargo, Citigroup, and JP Morgan Chase will each donate around $5 billion, while Goldman Sachs and Morgan Stanley will contribute roughly $2 billion, according to a new statement from the bank. Truist, PNC, US Bancorp, State Street, and Bank of New York Mellon will each deposit around $1 billion. They have all pledged to maintain the funds in the First Republic for a minimum of 120 days. Regional bank stocks dipped early last week Thursday but recovered following favorable and other information regarding the progress of the deposit scheme. The announcement comes after First Republic Bank shares have been hammered in recent days as a result of the failures of Silicon Valley Bank last Friday and Signature Bank the previous weekend. Each of those banks, as well as First Republic, had a significant number of uninsured deposits, raising concerns that clients might withdraw their funds. The major banks' new deposits are not insured. Needless to say, First Republic executives are overjoyed. So much money had been taken out of the bank in recent days that the stock was going for less than $20 per share at one time last Thursday. First Republic shares, which closed at $115 per share on March 8, were trading below $20. The stock was periodically suspended during the session and surged above $40 per share at one point, up more than 20% on the day. Did First Republic insiders see this coming? Before I answer that question, allow me to introduce you all to economic news. Please like the video if you're enjoying it so far and subscribe to the channel by clicking the red button and then ringing the bell icon so that you can stay up to date on our future uploads. Now, let us get back to the video. According to reports, First Republic Bank officials discreetly sold about $12 million in stock in the last 3 months. According to the Wall Street Journal, Executive Chairman James Herbert II sold the most shares of any other person, totaling $4.5 million since the beginning of the year. According to the journal, top executives at all 4 of the troubled banks have sold $11.8 million worth of shares so far this year at prices averaging just under $130 per share. Several of these sales occurred only days before the bank began experiencing liquidity issues, as anxious investors tried to recoup their losses following the failures of Silicon Valley Bank and Signature Bank. It is unknown whether the executives engage in insider trading. Investors are concerned about a possible recession, despite Treasury Secretary Janet Yellen's assurances last Thursday that the U.S. banking system is secure, noting that this week's actions demonstrate our resolve and commitment to ensure the federal financial system remains strong and depositors' savings remain safe. Many economic specialists have long argued that you only earn money in the stock market if you get out in time, and those men did. So, what was the problem with the First Republic? They, like Silicon Valley Bank and Signature Bank, were sitting on massive unrealized losses because the government bonds they held had lost a ton of value due to fast rising interest rates. Ultimately, the unrealized losses made a prospective First Republic acquisition undesirable to the too big to fail banks. Some weak banks were purchased for cheap by large corporations during the Great Financial Crisis in an effort to keep the banking system tranquil. However, the unrealized losses on First Republic's bond portfolio owing to last year's quick rise in interest rates have made an acquisition unpalatable. According to insiders, the markdown involving the bank's mature bond portfolio would amount to around a $25 billion hole on First Republic's balance sheet. First Republic generally serves high-end clientele, and the firm's offerings include wealth management and residential real estate financing. The corporation recorded more than $212 billion in assets at the end of December and produced more than $1.6 billion in net revenue last year. But the too large to fail banks are collectively sitting on hundreds of billions of dollars in unrealized losses and have trillions of dollars in derivatives exposure. So, who is going to save them when they start falling? That is a question we must all begin to consider. And if our banking industry continues to tremble, the consequences for our economy as a whole will be immense. A decrease in bank deposits will result in fewer high-powered money. In other words, there are more bank reserves in the system, which suggests the financial conditions are tighter than they have been in the past. It would be the final straw for an economy that was already on track to enter a recession by the summer. The trick has already begun, with bank deposits declining virtually by the same amount as bank holdings of treasuries and agency securities since last summer. This is because banks have net sold their securities to non-banks, resulting in a decrease in total bank deposits. This pattern is likely to persist. The graphic indicates that when the Federal Reserve System's central bank raises interest rates, banks usually drop their treasury holdings as a proportion of assets, with the ratio decreasing before and troughing during a recession. In order for existing economic system to work properly, we require stable banks and people's trust in those institutions. Despite the historic run on deposits that forced the bank to fail, most Americans still trust their banks for the time being. They also trust the government to manage the problem if their bank fails. And despite 2 past bank failures and indications that more may follow, most bank customers say they are at least somewhat optimistic that their money is safe. 7 in 10 consumers polled indicated that they still have faith in banks, compared to 2/3 of customers who said they trusted banks in February, according to the Morning Consult survey. Most Americans do not expect the crisis to harm them personally, but nearly 3/4 or 73% fear economic ramifications. With the collapse of Silicon Valley Bank, the second largest bank failure in U.S. history, along with the bankruptcies of Signature Bank and Silvergate Capital, 1 in 3 bank customers indicated that they are extremely sure they may withdraw their money, compared to 5% who said they are not at all confident. But the same cannot be said for individuals at the top of the economic food chain. In fact, many of them are currently withdrawing substantial sums from their banks while they can. According to wealth consultants, rich investors and family offices are shifting more of their money away from bank cash holdings and into treasuries, money markets, and other short-term commodities. High net worth individuals usually maintain millions, if not tens of millions of dollars in cash in their bank accounts to cover payments and unforeseen emergencies. Their holdings are frequently much in excess of the $250,000 insured limit set by the Federal Deposit Insurance Corporation. After the failure of Silicon Valley Bank and the possibility for holes in the network of regional banks, wealth advisors say many customers are now asking fundamental concerns about where and how to safeguard their money. The SVB issue has merely intensified a larger trend by rich investors to shift cash out of bank accounts and into treasuries and money markets during the last year. With the Federal Reserve's aggressive rate rises, treasuries and money markets may now offer a risk-free return of 4% to 5%, which is frequently double the interest on a savings or checking account. As a result, affluent investors and family offices have moved all but a tiny fraction of their cash holdings into better-yielding cash-like assets that are often not on the bank's balance sheets. At the same time, many large investors began to withdraw funds from stocks and other assets owing to fears about increasing interest rates and a probable recession. This crisis is only getting started. Each domino that falls will exacerbate the situation, and I believe the entire system is on the verge of a catastrophic disaster. So I'd advise you to do anything you can to protect yourself because things are just going to get wilder from here. Thank you so much for watching this video. Please comment down below your ideas and recommendations as to what to do in a case like this. Also, please do check out our other videos on the channel if you have additional time. That is all from me folks, and see you on the next video.